In this video, we're going to look at Enbridge. Enbridge is a Canadian oil and gas midstream company. And what I do in my videos is I try to figure out the intrinsic value of a stock, meaning I try to figure out the actual stock price, what it's really worth, not what it's trading at. And then I look at the financial ratios of the company as well. And I'm going to take you through the entire process of doing this so it's like you're doing it with me. So let's get started with the model. This company has a market cap of $81.6 billion. So they're trading at $40. That's 40 Canadian dollars. So one share of stock, that's how much it would cost you. Next, we're going to need the free cash flow. And free cash flow is the cash that's left over after operating your business. And the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. So you generally want to invest in a company that has positive free cash flow, because if they don't have positive free cash flow, that means there's really nothing left over for you, the investor. Unless they're investing in their operation, and it will result in more positive free cash flow in the future. Now I'm pulling the net income. That's on the income statement, and that's the profit and loss for the business. And then I'm going to pull the revenue, which are the sales for each year. And I'm going to put that into the model, and the model does all the work. And you can see in 2016 and 17, they had negative free cash flow. So they used more money than they generated. Yet they posted a positive net income. Mainly because the income statement uses accrual accounting and it depreciates assets over their life. Net profit margin is net income over revenue. So it's how well you convert revenue into profit. And it went from 6% 3 straight years to 11%. So they're becoming more efficient and more profitable. So that's a good sign. Let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. So they pay $2.7 billion on their debt. Let's see how much debt they have. We'll go to the balance sheet. Current debt is $5 billion. That's debt due within 1 year. Long-term debt of $60 billion. That's debt due after 1 year. And they pay 4.2% interest on their debt. Interest payments are tax deductible. So let's figure out their effective tax rate. We'll go back to the income statement. Income before tax is $7.5 billion. And they paid income tax of $1.7 billion. So their tax rate is 23%. That means their cost of debt is 3.3%. Now the cost of equity, we need the beta for that. And that's how much the stock moves relative to the entire market. So the beta is 0.95, which is pretty close to 1. So their stock moves with the market. So it's not too volatile. And now we need some more information from the balance sheet, because later on we're going to look at the financial ratios. So let's get their current assets. That's $8.8 billion. It's mainly cash, accounts receivables, and inventory. Current liabilities are what the company owes within the next 12 months, and that's $16 billion. And equity of $66 billion. Equity is total assets minus total liabilities. And now we'll pull their EBIT, earnings before interest and taxes. That's called operating income on the income statement, $8.7 billion. So that's how much money the company makes through its regular operational business. Let's look at a capital structure. So the cost of debt is 3.25%, and half of their capital structure is debt. And the cost of equity is 9.6%, and half of their capital structure is equity. So when you combine the cost of debt and the cost of equity, you get the weighted average cost of capital. And that's what we're going to use to discount the future cash flows, 6.46%. So we estimated 4 years of future free cash flows. That estimation is based off of prior financial information. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value for the company of 120 billion Canadian dollars. We divide that number by 2 billion shares and we get an intrinsic stock price of $59. So according to the model, it says the stock is actually worth $59 today, even though it's trading at $40. So it's trading at a 32% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They say the stock is worth $50 and they're saying it's 20% undervalued. I'm saying it's 32% undervalued. So we're in the same ballpark. We're both saying the stock is a buy. Let's look at the historical stock price to see where the stock has been trading. So it looks like it was trading closer to intrinsic value 3-4 years ago. And even before coronavirus, it was trading in the low 50s. But it's come down, as most stocks have, because investors feel the future of a lot of companies are not as strong as maybe they've done in the past. So let's look at the financial ratios to get more information. They have a good PE, it's under 15, 14.3. That's price to stock over earnings per share. Also a good price to sales ratio of 1.6. That's price to stock over sales per share. They have a really good price to book at 1.2. That's price to stock over book value per share. Let's look at that current ratio. It's 0.6. That's a little low. That means they can't cover their current liabilities with their current assets, so they would have to go into more debt. Unless this is a timing issue and possibly next quarter or the following quarter, this would be fixed. ROE at 9%, that's a bit low. That's income over equity. I'd like to see above 20%, so they're not providing the best value to their equity holders. They can cover their interest payment a little more than 3 times, so that's a good sign that they're probably not going to be going into default anytime soon. The best way to look at ratios is to compare them to similar companies. I've done videos on MPLX and ONEOK. These are both American companies. Enbridge is Canadian, but you could still compare the ratios. It's just the market cap is in the home country's currency. So the PE, Enbridge is worse than the average in PE. They're 14, the average is 13.5. They're a little worse than the average in price to sales, but they have a good price to sales ratio. ONEOK is the best in both of those categories. Price to book, they're the best in price to book at 1.2. All companies are struggling in current ratio. Maybe their revenues are down from previous years due to coronavirus. The only company that has a good ROE is ONEOK. The other two don't have much of an ROE. Enbridge has the lowest amount of debt. ONEOK is not too bad. And MPLX is 100% debt. In terms of market cap, Enbridge is the largest. If you converted that 81.6 billion Canadian dollars to US dollars, it comes out to 60 billion US dollars, which is still quite a bit larger than the other two companies. So let me know what you think of the video. Hope you learned something new. Thanks for watching.